If you hold cash in a bank account, if you receive a paycheck denominated in dollars, euros, or pounds, if you're saving for retirement in any government-backed currency, what happened in the silver market over the past 14 days has already altered the purchasing power of every unit of currency you own. This is not a future event you can prepare for. It has already occurred. Silver crossed $108 per ounce on January 23, 2026, shattering the previous all-time high of $49.82 set in April 2011. The move from 28 in October 2024 to 108 in January 2026 represents a 286% increase in 15 months, and the fastest. This time, there are no Hunt brothers. There is no single manipulator. There is only mathematics, supply deficits, monetary debasement, and the slow recognition that the distinction between money and currency has reasserted itself after 50 years of suppression. I'm John A.G., and this is the Collapse Files. When the least manipulated price discovery mechanism in the monetary system moves 286% in 15 months during peacetime with low unemployment, what does it signal about the stability of the currencies it's being measured against? Silver opened trading on October 1st, 2024 at $28.14 per ounce. On January 23rd, 2026, it reached an intraday high of $108.73 before settling at $107.42. The move represents a 281% gain from the October starting point in 476 calendar days, an average increase of 59% per quarter, sustained across 5 consecutive quarters. The acceleration occurred in distinct phases, revealing escalating urgency. From October 2024 through March 2025, silver rose from $28 to $38, a 36% gain over 5 months, representing typical bull market behavior. From April through August 2025, it surged from $38 to $64.04, a 68% gain in 5 months, indicating serious stress entering the system. From September 2025 through January 2026, it exploded from $64 to $108, a 69% gain in 5 months, demonstrating loss of control. The velocity of the final phase is historically unprecedented outside of corners and squeezes. The $44 gain from $64 to $108 occurred in 153 days, an average of 0.29 per day. During the Hunt brothers manipulation, silver gained 0.24 per day on average. During the 2011 surge from the financial crisis lows, silver gained 0.19 per day at peak velocity. The current move exceeds both historical precedents in sustained daily velocity, while occurring across a broader base with deeper liquidity. Volume confirms genuine price discovery rather than manipulation. Average daily silver futures volume on COMEX during the rally exceeded 180,000 contracts, approximately 900 million ounces of paper silver trading daily. Physical silver annual mine production is approximately 840 million ounces. Daily futures volume now exceeds annual global mine supply, indicating massive capital flows seeking silver exposure through derivatives because physical supply cannot absorb demand. Physical markets show even more severe stress. Premiums on physical silver coins and bars over spot prices have exploded. American Silver Eagles, which typically trade at $2 to $3 premiums over spot, are trading at $14.18 premiums in January 2026. This means buyers purchasing 1-ounce coins are paying $122, $126, when spot is $108, a 17% premium. Canadian silver maples show similar premiums at $12.16 over spot. Generic 1-ounce rounds trade at $8.12 premiums. The premium expansion from typical $2 thrillers to current $8.18 represents a 300-500% increase in the physical premium component. Delivery stress on COMEX is visible in declining registered inventory available for delivery against futures contracts. COMEX registered silver inventory, metal available for immediate delivery, has declined from 98 million ounces in January 2024 to 43 million ounces in January 2026, a 56% decline. The gold to silver ratio has compressed dramatically, signaling silver is outperforming gold, which itself is at all-time highs. Gold reached $2,247 per ounce in January 2026. Industrial demand for silver has intensified due to solar panel production and electric vehicle manufacturing. Solar panels use approximately 20 grams of silver per panel. Global solar panel production in 2025 exceeded 750 gigawatts of capacity, consuming approximately 210 million ounces of silver, 25% of annual mine supply. Electric vehicles use 25-50 grams of silver per vehicle in electrical systems. EV production reached 18 million units in 2025, consuming approximately 18 million ounces. Combined solar and EV demand totals 228 million ounces, 27% of the 840 million ounce annual mine supply, representing industrial demand that is price inelastic and growing. The supply deficit has become structural. Annual silver mine production is approximately 840 million ounces. Industrial demand is 550 million ounces. Investment demand through coins, bars, and ETFs has surged to 320 million ounces annually. Combined demand of 870 million ounces exceeds supply by 30 million ounces, a 3.6% deficit. This deficit must be filled from either above-ground stockpiles, recycling, or price increases forcing demand destruction. With above-ground stockpiles difficult to quantify and recycling unable to scale quickly, the adjustment mechanism defaults to price increases. Silver functions in the modern monetary system as simultaneously an industrial commodity, an investment asset, and a monetary metal with 5,000 years of history as money. This tripartite nature creates unique dynamics where industrial demand provides price floor, investment demand drives volatility, and monetary demand emerges during currency confidence crises. The system is designed to suppress silver's monetary function through paper derivative markets that allow price discovery to occur through futures trading rather than physical settlement. COMEX silver futures allow participants to gain silver exposure without taking delivery of physical metal. This creates leverage. A buyer of one futures contract controls 5,000 ounces of silver by posting margin of approximately $7,000 to $10,000, depending on volatility. The leverage ratio exceeds 30.1 at current prices, meaning participants control $540,000 of silver exposure with $10,000 of capital. This leverage serves a critical function in the fiat monetary system. If silver price discovery occurred only through physical transactions, available supply would be exhausted quickly during periods of elevated investment demand, forcing prices dramatically higher and revealing the currency debasement that drives the demand. Paper derivatives allow price discovery through essentially unlimited supply of paper contracts, preventing physical shortages from immediately affecting prices, and thus preventing silver from performing its historical function as a barometer of monetary debasement. The mechanism functions smoothly when physical delivery demands remain modest. Futures markets exist primarily for hedging and speculation with minimal delivery intention. Miners use futures to lock in prices for future production. Industrial users hedge input costs. Speculators provide liquidity-seeking profits from price moves. The physical settlement that occurs represents perhaps 2 to 3% of total contract volume, enough to anchor paper prices to physical reality, but not enough to stress available inventory. The system begins failing when delivery demands increase beyond available registered inventory. In normal functioning, COMEX maintains registered inventory of 80 or 100 million ounces available for delivery. Daily delivery obligations might be 1 to 2 million ounces. The ratio provides comfortable buffer. But when investment demand surges and participants begin demanding physical delivery rather than cash settlement, the registered inventory depletes. Once inventory falls below a threshold, approximately 4 to 50 million ounces, remaining longs recognize that delivery is becoming scarce, creating incentive to demand delivery preemptively before inventory exhaustion. This creates a reflexive dynamic. Declining inventory causes increased delivery demands. Increased delivery demands further deplete inventory. Depleted inventory causes price increases. Price increases attract more investment demand. New investment demand includes participants specifically seeking delivery, accelerating inventory depletion. The cycle feeds on itself until either the exchange changes rules to prevent delivery demands, prices rise high enough to destroy marginal investment demand, or new supply emerges. Currently, the system is trapped in early stages of this dynamic. Registered inventory at 43 million ounces represents approximately 200 days of typical delivery obligations. But delivery obligations are not typical. They have increased 340% year over year as investment demand surges. At current delivery pace, 43 million ounces represents 58 days of inventory. The compression from 200 days to 58 days of coverage indicates the buffer is evaporating. Market participants are trapped in conflicting incentives. Shorts, participants who have sold silver futures without owning physical, must either deliver physical silver or buy back their contracts to close positions. If they attempt to buy physical to deliver, they compete for limited supply, driving prices higher and worsening their losses. If they buy back futures to close positions, they create buying pressure that also drives prices higher. Either action worsens the price move against them. Longs, participants who own futures and demand delivery, recognize that inventory is constrained and are incentivized to demand delivery before others exhaust available supply. This creates a coordination problem where individual rational behavior, demanding delivery to secure physical before others, collectively creates pressure that exhausts inventory faster. COMEX faces institutional constraints. The exchange must maintain orderly markets and cannot allow delivery failures that would destroy confidence in the futures mechanism. But orderly markets require sufficient inventory to satisfy delivery demands. If inventory approaches exhaustion, the exchange faces binary choices: change rules to limit delivery demands, force cash settlement at prices disconnected from physical markets, or allow prices to rise until marginal buyers withdraw and delivery demands moderate. Rule changes would destroy confidence in the futures mechanism as a price discovery tool. If participants cannot trust they can demand delivery, futures prices become disconnected from physical, creating two-tier pricing: paper silver trading at one price, physical at another. This occurred briefly during the Hunt Brothers episode, when COMEX implemented position limits and increased margin requirements to force liquidation. Cash settlement at exchange-determined prices would be contested legally and would reveal that paper claims exceed physical availability, an acknowledgement that the derivative structure cannot perform its essential function of allowing settlement in underlying commodity. This would collapse confidence not just in silver futures, but potentially in commodity derivatives broadly. Allowing prices to rise until demand moderates requires accepting that silver could reach levels $150, $200, potentially higher, that would signal severe monetary debasement, and potentially trigger increased demand for other monetary metals like gold, creating contagion. The exchange is trapped between maintaining orderly markets and acknowledging that the paper-to-physical ratio has reached unsustainable levels. The quantitative evidence reveals not just a price increase, but a systematic repricing of silver relative to currencies, gold, and industrial commodities, indicating a monetary regime shift is underway. Silver's 286% gain from $28 to $108 over 15 months compares to gold's 47% gain from $136 to $2,147 over the same period. Silver outperformed gold by a ratio of 6.1.1. For every percentage point gold gained, silver gained 6.1 percentage points. This outperformance ratio exceeds the 2010-2011 period, when silver gained 4.8 percentage points for every gold percentage point during the run from $18 to $49. The current outperformance suggests either silver was more severely undervalued than in 2010, or that industrial demand is adding pressure beyond monetary demand alone. The gold to silver ratio compression from 89.1 to 26.4.1 represents a 70% compression in 15 months. Historical analysis shows the ratio compressed from 100.1 to 31.1 during the 1979-1980 Hunt Brothers episode, a 69% compression in 18 months. The current compression matches that velocity but occurs over a broader market with deeper liquidity, suggesting genuine supply-demand dynamics rather than manipulation. Physical premiums expanding from 2 out of 3 to 8 or 18 over spot represent a 300-500% increase in the premium component. This premium represents the additional cost buyers pay for physical delivery over paper prices. When premiums expand dramatically, it signals physical supply cannot meet demand at prevailing paper prices. The current premium levels match those seen in March 2020 during pandemic-driven physical buying panic, when premiums briefly reached $10-14. But March 2020, premiums collapsed within weeks as supply chains normalized. Current premiums have sustained for over 5 months and continue expanding, indicating structural shortage rather than temporary disruption. COMEX inventory depletion from 98 million ounces to 43 million ounces represents a 56% decline in available supply for delivery. The decline occurred as open interest increased 34%, from 875 million ounces to 1.17 billion ounces. Industrial demand growth rates confirm price inelastic consumption, creating structural deficits. Solar panel silver consumption increased from 140 million ounces in 2022 to 210 million ounces in 2025, a 50% increase in 3 years driven by global decarbonization efforts. EV silver consumption increased from 8 million ounces in 2022 to 18 million ounces in 2025, a 125% increase. Combined, these two sectors alone consume 228 million ounces, 27% of annual mine supply, and both are growing at double-digit annual rates. Solar installations are projected to grow 20% annually through 2030. EV production is projected to grow 15% annually. These consumption rates will reach 320 million ounces by 2028, 38% of current mine supply, creating structural deficits that must be resolved through either dramatically higher prices destroying marginal demand or substitution technologies that are years away from commercial viability. Mine supply response to higher prices has been minimal, indicating production constraints are binding. Silver mine production increased from 820 million ounces in 2022 to 840 million ounces in 2025, a 2.4% increase despite prices rising from 21 to 108, a 414% price increase. The muted supply response indicates silver is primarily a byproduct of base metal mining, Approximately 70% of silver comes from copper, zinc, and lead mines. Silver prices rising do not incentivize new silver-specific mining because the economics depend on base metal prices. Base metal prices have been weak due to China construction slowdown, limiting mine supply response. Central bank behavior shows divergence. While central banks globally have purchased over 3,000 metric tons of gold in the past 3 years, official silver purchases are negligible. Central banks do not hold silver reserves. This creates asymmetry. Gold price increases are partially driven by official sector buying. Silver price increases are driven entirely by private sector demand, industrial users, investors, and speculators. The absence of central bank buying suggests silver's rise is purely market-driven without official sector support or suppression. Currency debasement metrics provide context. M2 money supply in the United States has increased from 15.5 trillion in January 2020 to 21.8 trillion in January 2026, a 41% increase in 6 years. Silver's 286% gain over 15 months far exceeds the 41% 6-year monetary expansion, suggesting silver is not just tracking monetary debasement, but front-running expectations of future debasement or reflecting supply scarcity independent of monetary factors. The silver-to-oil ratio shows silver gaining purchasing power against energy. In October 2024, 1 ounce of silver at $28 bought 0.39 barrels of oil at $72 per barrel. In January 2026, 1 ounce at 108 buys 1.44 barrels at 75 per barrel, a 269% increase in silver's purchasing power against oil. This suggests silver is gaining real value, not just nominal price inflation. The Hunt Brothers Silver Corner of 1979-1980 provides the closest parallel in magnitude and velocity, but differs critically in mechanism. Nelson Bunker Hunt and William Herbert Hunt accumulated over 100 million ounces of physical silver and controlled an additional 90 million ounces through futures contracts by late 1979. Their buying drove silver from $6 per ounce in January 1979 to $50 in January 1980, a 733% gain in 12 months. The Hunts financed purchases through borrowed money, using silver holdings as collateral for loans to buy more silver, classic leverage creating a self-reinforcing cycle. When COMEX changed rules in January 1980, implementing position limits restricting how many contracts one entity could hold, and raising margin requirements forcing liquidation, the Hunts could not meet margin calls. They were forced to liquidate, driving silver from $50 to $10 by March 1980, an 80% collapse in 60 days. The critical difference is the current move lacks a concentrated manipulator. No single entity controls 100 million ounces. Buying is distributed across industrial users, securing supply, investors seeking monetary hedge, and speculators momentum trading. This distributed demand is more difficult to break because there is no single entity to target with rule changes or margin calls. Additionally, the Hunts bought primarily futures with leverage, while current buyers include substantial physical buyers willing to take delivery, creating different stress on the system. The 2010-2011 silver surge from 18 to 49 occurred during sovereign debt crisis stress in Europe and quantitative easing implementation globally. The Federal Reserve had implemented QE1 in 2009 and QE2 in 2010, expanding its balance sheet from $800 billion to $2.8 trillion. European Central Bank was managing Greek debt crisis. Investors sought hard assets, anticipating currency debasement. Silver gained 172% from September 2010 to April 2011, before correcting 45% over subsequent months. The 2011 episode ended when the Fed signaled QE2 would conclude without immediate QE3, temporarily reducing debasement expectations. Additionally, industrial demand weakened as China's economy slowed and industrial production moderated. The combination of reduced monetary fears and weakening industrial demand allowed prices to correct substantially. Current conditions differ because monetary debasement has not paused. Federal deficits exceed $2 trillion annually, requiring Fed intervention to suppress yields, and industrial demand is accelerating through solar and EV rather than weakening. The absence of an obvious catalyst to reverse current conditions suggests this episode may persist longer than 2011. This brief surge, the Weimar hyperinflation of 1921 to 1923, provides insight into how hard assets behave during extreme currency debasement. As the German mark lost value, precious metals became informal currency. Anecdotal accounts described workers receiving wages in banknotes and immediately purchasing tangible goods or metals before the currency lost additional value within hours. Silver and gold became mediums of exchange, where trust in the mark collapsed entirely. The Weimar precedent is extreme, but the mechanism is relevant. When confidence in fiat currency erodes, whether from excessive debt, monetary expansion, or fiscal dysfunction, holders seek to exchange currency for tangible stores of value. The velocity of that exchange, how quickly people seek to exit currency, determines how rapidly precious metals reprice. The 1933 U.S. gold confiscation under Executive Order 6102 demonstrates government response to precious metal price surges, threatening currency confidence. President Roosevelt prohibited private gold ownership and required citizens to sell gold to the government at 20.67 per ounce. After collection, Roosevelt revalued gold to $35 per ounce, a 69% devaluation of the dollar against gold. The confiscation prevented gold from performing its function as a check on currency debasement by removing it from private hands. Silver was not confiscated in 1933, but was later demonetized through the Coinage Act of 1965, which removed silver from quarters and dimes, and the 1970 Bank Holding Company Act amendments that removed silver backing from Federal Reserve notes. The systematic removal of silver from monetary functions was deliberate policy to eliminate constraints on fiat money creation. These precedents show governments respond to precious metal price surges either through rule changes limiting trading, Hunt Brothers, policy reversals reducing debasement, 2011, or confiscation and demonetization, 1933-1965. The current environment offers limited options. Rule changes would destroy COMEX credibility. Policy reversal requires accepting inflation or fiscal crisis. Confiscation faces constitutional and practical obstacles in modern society. The lack of obvious intervention mechanisms suggests the current move may have further to run. The mainstream financial narrative frames silver's surge as speculative excess or industrial shortage, creating temporary price distortion. This framing serves multiple institutional interests with incentive to downplay monetary implications. Central banks have no interest in acknowledging silver's rise as a monetary signal. If silver at $100 reflects currency debasement or loss of confidence in fiat money, it implies central bank policies, quantitative easing, negative real rates, fiscal dominance, have undermined currency stability. Acknowledging this requires admitting policy failure. The preferred narrative is that silver is simply an industrial commodity experiencing supply-demand imbalance that will resolve as substitution occurs or mines ramp production. Commercial banks holding derivative positions have direct exposure to silver price moves. Major banks act as market makers in precious metals, taking opposite positions to customer trades. Banks that sold silver futures at $30, $40, $50 now face massive losses at $100. These banks are typically too big to fail institutions with lobbying influence. Their interest is to frame the move as temporary speculation that will correct, allowing them to avoid crystallizing losses and potentially receiving regulatory forbearance to unwind positions gradually. Government fiscal interests align against acknowledging monetary debasement. If silver's rise reflects dollar weakness, it implies treasury bonds, the foundation of government finance, are losing real value. Foreign holders of $7.3 trillion in treasuries would recognize they are being inflated away, potentially reducing demand for new issuance. Domestic holders would demand higher yields to compensate for debasement risk. The government's interest is to maintain narrative that the dollar is strong, inflation is transitory, and precious metal moves are speculative noise. The element most people miss is the second-order effect on industrial users facing supply scarcity. Solar panel manufacturers require silver for photovoltaic cells. If silver continues rising, either solar panel costs increase dramatically, reducing deployment, or manufacturers must redesign products using alternative materials. Redesign requires years of R&D and retooling factories. In the interim, solar deployment slows, undermining decarbonization goals. This creates policy conflict. Governments committed to net zero emissions depend on solar deployment that depends on affordable silver. Rising silver prices force choice between climate goals and monetary stability. The wealth transfer mechanism is underappreciated. Silver's rise from $28 to $108 represents a 286% gain. Holders who purchased silver in October 2024 have nearly quadrupled purchasing power. The gains come from those who held cash or bonds that depreciated in real terms relative to silver. This represents massive wealth transfer from savers in fiat currency to holders of tangible assets. The mainstream narrative avoids discussing wealth transfers because it creates political tension. Those who lost purchasing power question why their savings depreciated while tangible assets surged. The reflexivity is being ignored. Rising silver prices attract attention from investors who previously ignored precious metals. Media coverage of $100 silver creates awareness among retail investors who then purchase, driving prices higher, creating more media coverage, attracting more investors. This reflexive loop can continue until either supply materially increases or demand is destroyed through price reaching levels where marginal buyers capitulate. The loop is inherently unstable and prone to overshoot in both directions. The systemic fragility emerging in derivative markets is hidden from most observers. The 27.21 paper to physical ratio on COMEX is known only to those following exchange data. The general public assumes when they buy silver futures, they can demand delivery. The reality is that if even 10% of contract holders demand delivery, available inventory is exhausted within days. This creates systemic risk, a bank run dynamic where participants rush to exit before others, accelerating the very crisis they fear. The comparison to other markets is revealing. Equity markets trade with ample underlying shares. Bond markets settle in fiat currency, which can be created unlimited. Silver futures trade with fixed physical supply that cannot be expanded quickly. When confidence in settlement capacity erodes, the dynamics become unstable in ways that do not affect other markets. The historical pattern that mainstream analysis ignores is that precious metal price surges precede rather than follow currency crises. In 1979 to 1980, gold and silver surged before the dollar index collapsed. In 2010-2011, metals surged before European sovereign debt crisis peaked. Metals do not wait for crisis to fully manifest. They front-run recognition. The current surge suggests market participants with access to physical metals recognize something about monetary stability that official narratives have not yet acknowledged. The signal warns that the distinction between money, a store of value across time, and currency, a medium of exchange for transactions, has reasserted itself after 5 decades of suppression through fiat monetary systems that attempted to make currency serve both functions. From 1971, when Nixon closed the gold window through 2024, the fiat system maintained the illusion that currency issued by central banks could serve as both medium of exchange and store of value. The illusion persisted because inflation was modest, 2 to 3% annually, and alternatives like gold and silver were actively suppressed through paper derivative markets, creating the appearance of ample supply. Anyone seeking hard assets could be satisfied through paper exposure without stressing physical supply. Silver at $108 signals the illusion is breaking. Physical premiums at 13-17% over spot demonstrate paper and physical have diverged. Paper trades at one price, physical at another. This two-tier pricing reveals that paper claims exceed physical availability, destroying the function of paper derivatives as substitutes for physical. Once paper and physical diverge, the derivative pricing mechanism loses credibility and price discovery shifts toward physical markets where supply is constrained. The implications for broader monetary confidence are severe. If silver, a relatively small market with limited monetary history in recent decades, can experience supply exhaustion forcing prices up 286%, what prevents the same dynamic in gold, which has stronger monetary associations and deeper official sector involvement? The warning for currency stability is that when physical hard assets begin pricing materially above their paper derivatives, it signals loss of confidence in the currency the derivatives settle in. If futures markets cannot deliver physical at paper prices, participants recognize the currency-denominated claims are worth less than physical assets. This recognition spreads to other markets, bonds, equities, real estate, creating broad rotation from financial assets into tangible assets. What breaks first historically is trust in the settlement mechanism. During 1979-1980, COMEX broke trust by changing rules mid-crisis to force liquidation. During 2011, MF Global broke trust by hypothecating customer metal deposits, leading to bankruptcy when metals couldn't be returned. The current stress on COMEX inventory suggests trust could break again if delivery demands exhaust registered silver and the exchange is forced to either change rules or admit insufficient inventory exists to honor contracts. The secondary break occurs in currency perception. When physical hard assets rise 286% in 15 months, while currencies are supposedly stable with 2 to 3% inflation, the divergence forces recognition that either assets are in a bubble or currencies are debasing faster than official statistics acknowledge. Given that silver's rise is driven by industrial demand fundamentals, plus investment demand, and not obvious speculation, the currency debasement explanation becomes more credible. The signal warns that we are in the early stages of a repricing where decades of accumulated monetary expansion are being recognized in hard asset prices. The repricing can continue gradually if supply increases or demand moderates. Or it can accelerate if confidence in paper settlement breaks, forcing sudden rotation into physical assets that cannot absorb the flow without explosive price increases. Silver crossed $108 per ounce on January 23, 2026. Completing a 286% gain from $28 in October 2024. The move occurred in 15 months, faster than the 2010-2011 surge, comparable to the Hunt brothers' 1979-1980 manipulation, but without a manipulator. Industrial demand consumes 550 million ounces annually and is growing at double-digit rates through solar and EV. Investment demand has surged to 320 million ounces annually. Combined demand of 870 million ounces exceeds mine supply of 840 million ounces by 3.6%. The deficit must be filled from above-ground stocks, or higher prices destroying marginal demand. COMEX registered inventory has fallen 56% to 43 million ounces, while open interest increased 34% to 1.17 billion ounces. The gold-to-silver ratio compressed from 89.1 to 26.4.1, a 70% compression matching the 1979-1980 velocity, but occurring across deeper markets, suggesting genuine price discovery rather than manipulation. Historical precedents show precious metal surges end through rule changes, destroying confidence in settlement, policy reversals reducing monetary expansion, or government confiscation. Current conditions offer limited intervention options. Rule changes would destroy COMEX credibility. Policy reversal requires accepting inflation or fiscal crisis. Confiscation faces practical obstacles. The signal is not that silver has reached a peak or that collapse is imminent. The signal is that the physical supply constraints in the least manipulated corner of the monetary system have begun forcing price discovery that reflects either the reality of monetary debasement or the mathematics of supply deficits that cannot be resolved quickly. What remains is observing whether the system can reestablish equilibrium through supply increases and demand moderation, or whether the dynamic accelerates as confidence in paper settlement breaks and forces recognition that 5 decades of monetary expansion are repricing through the only assets that cannot be printed.